everyone, this is Lauren Mack with Hacking the Rat Race. And today, I'm going to answer a question that I received from an Ask Lauren Mack post. The question was, hello Lauren, do you really need Spotless credit to buy a house nowadays? Everyone tells me that I could pay a little more than I pay now for rent and get a house. Alas, I don't think it's that easy. Keep up your great work. To answer that question, we're going to look at 4 different types of mortgage loans and what the requirements are for qualification for each of them in order to help answer this question. I would also like to say thank you so much for asking this question. If you're watching this and have a question you would like me to answer in a video or short, feel free to post them below with hashtag AskLaurenMack. So let's jump right in. In this video, I'm going to be breaking down 4 different options with examples at the time of recording of this video. So, depending on when you're watching it, will be a good idea to check the updated mortgage rates, etc. Additionally, anytime you're house shopping, I highly recommend getting at least 3 quotes. I would get one from a bank, a mortgage broker, and a mortgage lender. I would ask them to give you a quote on all the different types of loans you qualify for so that you can compare apples to apples when making the decision on which lender you choose. You will be surprised at the differences. For example, depending on your credit, one may accept you while another may not, or there could be significant differences in interest rates, as well as closing costs and fees. I always recommend getting at least 3 quotes from 3 different types of sources. If you stay until the end of this video, I'm going to give you a bonus tip on how you can save money on a house, even in the current market, which could offset your higher monthly mortgage payment due to the increased interest rates. Now let's jump into the options. First, have you ever served in the United States Armed Forces? If so, then you could be eligible for a VA loan. According to Veterans United, the VA loan is a $0 down payment option available for veterans, service members, and select military and their families. VA loans are issued by private lenders such as mortgage companies or banks and guaranteed by the U.S. Department of Veteran Affairs, the VA. The VA home loan was created in 1944 by the United States government to help returning service members purchase homes without needing a down payment or excellent credit. This historic program has guaranteed more than 25 million loans, helping veterans, active duty military members, and their families purchase or refinance a home. This could be a great option for active duty service members and veterans. So, you might be wondering, what is the minimum credit score for this type of loan? Well, the VA does not have a set minimum credit score for the VA loans it guarantees. Rather, it asks the lender to instead review the full loan profile of the individual applying for the VA loan. So this enables lenders to establish their own minimum credit scores for VA loans. This is a reason why you can often see different lenders requiring different credit scores. As an example, let's look at Freedom Mortgage and what they offer. At Freedom Mortgage, the minimum credit score they require depends on the purpose of the VA loan. Here are minimum current credit scores. When you want to buy a home with a VA loan, they can often accept a minimum credit score as low as 550. When you want to refinance a home with a VA loan, we can often offer easy credit score qualification. When you want to get cash with your home equity from a VA loan, they can often accept a minimum credit score as low as 550. So, as you can see from this example, a low credit score doesn't necessarily mean you won't get approved for the VA loan. However, if you have a higher credit score, this may mean you get a better interest rate or loan terms. As a general rule, mortgage lenders usually offer the best interest rates to borrowers who have the best credit. If you're getting value from this video, don't forget to poke the like button. So now let's take a look at our next loan option, which is the FHA loans. FHA loans are a great option for first-time homebuyers because they offer mortgage loans with lower down payments. This is terrific for those who are tired of renting and want to get into a home without having to put a lot of money down. Even though this is a great benefit for many people, recent changes in policies might have made these types of loans a little more difficult to obtain for some potential homeowners with shaky credit history. Let's take a look at some examples. For would-be homebuyers submitting an application to qualify for an FHA loan, applicants are now required to have a minimum FICO score of 580 in order to qualify for loan down payment benefits, which currently sits at about 3.5%. If you have a credit score that's below 580, however, you aren't necessarily excluded from FHA loan eligibility. Those applicants who have lower credit scores will need to put down a 10% down payment instead of the 3.5% if they want to qualify for a loan. This means that if you're planning to buy a house and your credit score doesn't meet the minimum requirements, you should carefully weigh the pros and cons of putting down a larger down payment. Saving up a down payment for your first house can be challenging. When we decided to get married, we asked our wedding guests to donate to a housing fund instead of buying us gifts like vases and towels. As a result, we were able to save up enough money for a down payment on our first home. FHA loans are popular because borrowers that qualify for them are able to take advantage of benefits and protections that are not available with more traditional mortgage loans. FHA loans are insured by the agency, so lenders tend to be more lenient. Let's talk about the benefits of an FHA loan. Usually, most loans exclude those applying with poor credit history and low credit scores. However, the FHA makes loans available with lower requirements, thereby making the qualification process easier. Typically, FHA loans offer lower interest rates in order to help homeowners afford their housing payments. They have lower fees. Usually with FHA loans, you're getting the benefit of a lower cost on other fees like closing costs, mortgage insurance, and others. Bankruptcy and foreclosure. Even if you filed for bankruptcy or had a foreclosure in the past few years, you can still qualify for an FHA loan, as long as you meet other requirements that satisfy the FHA, such as reestablishment of good credit, solid payment history. It's possible to qualify. No credit. In most cases, the FHA usually requires 2 lines of credit for qualifying loan applicants. If you don't have much credit history, you can always try to qualify through a substitute form. Since we're talking about the pros of getting an FHA loan, I would also like to talk about the con as well. FHA loans are great, but if you only put the minimum amount required down, you will be required to pay mortgage insurance, which can oftentimes add a significant amount to your monthly mortgage payment, and depending on your credit score and creditworthiness, this amount can increase. Mortgage insurance is not uncommon. However, for FHA loans, if you only put a small amount down, for example, 3 to 5%, then the mortgage insurance is for the life of the loan. This makes a big difference because next we're going to discuss conventional loans. And while they also require mortgage insurance on loans with a down payment that is less than 20%, it will be removed once your loan is scheduled to hit 80% loan to value based on your payments. And there are a couple other ways to get it removed sooner as well. That being said, conventional loans are more stringent, so if you don't qualify for one due to low credit score or credit history, then FHA is always an option. Before I explain conventional loans, I want to hear from you in the comments below. How soon do you think you'll be buying a house? The next loans we're going to talk about are conventional loans. Conventional loans are any mortgage loans not backed by the federal government. Most conventional loans fall into the category of conforming loans. There are mortgages that meet lending standards set by Fannie Mae and Freddie Mac. Even though these loans are regulated by Fannie and Freddie, conventional loans are offered by private lenders. You can get one from most banks, mortgage lenders, or mortgage brokers. Most U.S. mortgages are conventional loans, and if you're buying a home, there's a good chance this is a type of loan you'll use. So how do you qualify for a conventional loan? Conventional loan requirements vary by lender. However, most conventional loans need to meet some basic criteria established by Fannie Mae and Freddie Mac. These include a minimum credit score of 620, a debt-to-income ratio lower than 43%. It can be higher depending on qualifying factors. The debt-to-income ratio compares how much debt you have each month compared to how much income you bring in. So, if you make $4,000 per month, but you pay $2,000 per month in debt, then your debt-to-income ratio is 50%. To calculate your debt-to-income ratio, you divide your monthly debt amount by your monthly income amount, and you want it to be less than 0.43 or 43%. Last, you must have a down payment of at least 3%. As I mentioned before, if you're putting less than 20% down on conventional loans, you'll have to pay mortgage insurance. But for conventional loans, it can be removed and is not for the life of the loan. This can be a big advantage over FHA loans. As a side note, I personally have always used conventional mortgages for all my loans, but depending on your credit history and score, one of the other options could be better for you. The next type of loan we're going to talk about is the USDA loan. USDA loans are mortgage loans offered to rural property owners by the U.S. Department of Agriculture. This can be a great option for those people who live in more rural areas of the country. USDA loans are popular with borrowers that have lower credit scores and lower income. Actually, the USDA programs are designed for lower income individuals and families. In fact, there are actually limits to how much money you can make. According to the USDA, the minimum credit score needed to get a USDA loan is 640. Prior to 2017, this was 620. However, if your credit score is below 620, but you have sufficient compensating factors, you may be able to get a USDA loan. Your application will have to be manually reviewed in order to obtain approval. In addition to the credit score requirements, you must also satisfy other conditions related to your credit. This includes mandatory waiting periods after major credit events, such as bankruptcy, foreclosure, short sale, normally around 2 years. Additionally, you must be able to show at least 3 different types of credit on your credit report, such as credit cards, auto loans. If you do not have sufficient lines of credit on your credit report, you may still qualify with alternative forms of credit, such as phone bills, utility payments, even a gym membership. In cases where a borrower does not meet certain loan requirements, such as the minimum credit score or debt-to-income ratios, it's still possible to qualify for a USDA loan if you have certain compensating factors. If the borrower has a credit score lower than 640, but has low debt-to-income ratios, money in savings, or a long time on the same job, it's still possible to qualify. Additionally, if the borrower's debt-to-income ratio are higher, but they have good credit, 660 or higher, then approval is still possible. One thing I would like to add, you should always check to see if there's a USDA loan available in the area you're looking for housing, because it's not solely in rural areas. I've seen USDA loans in towns, even the outskirts or suburbs, parts of big cities. It is always worth checking because if you qualify for a USDA loan, they have more lenient lending requirements as just described. So, to answer your question, you can definitely still get approved for a mortgage despite not having spotless credit. Even though interest rates are rising and home prices might seem out of reach, it's still possible to get a good deal on a home right now, even though interest rates are on the rise. So, now, for the bonus tip I promised you on how to get a good deal on a house in this market. Since June, the housing market has slowed down considerably, and as a result, homes are sitting on the market for a lot longer period of time. Many of these homeowners need to sell their property quickly, which can give an advantage to the home buyers. This means that you can often submit an offer on a home that is well below its asking price and it would be accepted. This is one way to offset the rise and interest rates by simply paying less for the house. When deciding which realtor you want to work with, you may want to choose one who is not afraid to put in multiple lowball offers. You can go on sites like realtor.com to see houses for sale, how many days the house has been sitting on the market, and if they reduce the price. More than likely, homes that have been sitting on the market for a longer period of time, such as more than 30 days, would be willing to negotiate a better price. For example, if you would have gotten a $350,000 mortgage at a 3.5% interest rate, your payment would have been $1,990 per month. Depending on your location, the taxes and insurance can be different, which can impact the monthly price. Now, the exact same mortgage at a 5.5% interest rate, you would be paying $2,636 per month. Now, if you found a house that started at $350,000 but has been sitting on the market for more than 30 days and has dropped the price, you could offer them, say, $300,000. If they accept, all things the same, the payment on the $300,000 house with a 5.5% interest rate would be $2,274, which is closer to the amount you would have paid on that house at $350,000 with a 3.5% interest rate. If you're watching this video and you're considering becoming a real estate investor or want to know how you can retire early by real estate investing, check out this video right here.